you're talking about a collapse. We're in the end years of a super cycle. I define a super cycle as that period between the one depression and the next depression. So the Great Depression was the 1930s. The next depression is that mid 2030s, I think. So it's 100 years basically between them. And yes, we have a bust before the final depression. This is not a depression. If it lasts a year or 18 months, it's not a depression. But it's going to feel like one, but it's not a depression. But that period between the 1930s and the 2030s is a super cycle. We're in the last decade of that, maybe less. And that's why everything's starting to come to a head, why everything's going to get to such extremes.
Welcome to the Rose Show podcast. You started speaking about this catalyst, what could be causing this bust? And that was my next question. So you foresee a bust occurring towards the end of 25, maybe as late as early 26. And so catalysts, besides every bull piling into the market, just everyone's just so bullish and so excited and sentiment has changed. The Fed would be cutting probably as well. So the catalyst that you foresee, because there's a lot of fragility under the surface and the global bust refers to the economy, not the market. What are some catalysts that we can watch out for? You think the tariffs, anything else that you're thinking about?
Yeah, because I think the big elephant in the room, the real question I need to answer before we get to that is because all I've been doing is talking about how bad things are going to get. And then that begs the question, how can you be so bullish on the stock market when you're talking about a recession, either, already being in a recession or starting this summer, and, the tariff news leading to a bust and or the tariff policy leading to a bust and all the other negatives you're throwing out there. Why would the market go to 8,000? And why would the NASDAQ go to 27,000? And why would the Russell go to 3,300? And the answer is part of it is the bond market. The fact that rates will be coming down sharply will be a part of it. Part of it is because I think the Fed will be easing. Like I said, I don't know if it'll start in June or later, but the Fed will be part of it. They will follow the bond market. And part of it will be the understanding or the belief on the part of the street that once you see those things, you can start looking over the trough to the earnings on the other side. That's what we've been lacking, is because the Fed's been tightening. It's hard to jump to that conclusion that, yeah, we already know what the trough is because the Fed's defined. Once they start easing, you can define the trough or think you can define the trough and you can look over it. If you've got the narrative that will drive that final run will be sharply lower rates, earnings still relatively intact. And again, I'm not sure all these are going to prove out true in the end, but the narrative will be, earnings still intact, rates coming down sharply, the Fed on board easing, a new cycle beginning over the trough, and so we can start looking at 2026 earnings in a positive light, not a negative light, et cetera. That's really what gets it, and the fact that you have everybody so negative that they now have to reposition themselves. If they were all bullish and this were the case, they'd already be positioned for it, but they're not. They're positioned for the negative. So you'll get a concentrated period of a few months where both retail and institutional will be jumping on, and then obviously FOMO takes over. Once you get the momentum of the tape, that's really what drives that final move. So that gets that out of the way, and then the question is, like you said, what are the catalysts for the bust? And I repeat, the recession is really, we've been kind of trending down in the economy towards a recession anyway. We have a have and have not economy where things can look okay because the haves are spending, but the have nots are barely surviving. They're having trouble putting food on the table. They're having trouble meeting their monthly budgets. Discretionary spending is not something they can do anymore, or very little of it. But they're being disguised by the fact that the haves have, you know, fully, home prices up near the highs, stock prices not far from the highs, and the haves doing, saying, "Hey, things are great. What are you talking about? Nothing's bad for me." Even the haves are showing signs that things are starting to sour. So as the haves start pairing up, starting to peel off a little bit in their spending, and the have-nots continue to worsen, you get into a tough period. We see it in delinquencies, loan delinquencies. We see it in some of the buying of big ticket items and things, so that you're beginning to see, certainly in certain areas, certain pockets, real estate's rolling over. In Florida, in Texas, real estate is rolling over pretty decisively already. In other areas, it's not. And I should say, housing probably does bounce here as rates come down. But you're not starting up a new leg in housing. It's just, we've seen the peak in housing, and it's gradually beginning to deteriorate, but could bounce into the summer as mortgage rates come down and some of that pent up demand comes back in and says, "Oh, I finally have a chance to buy. I better grab before rates go up." They're being told rates are going higher, not lower. So if you get a 6% mortgage after seeing a 7% mortgage rate, you're thinking you're getting a bargain, even though ultimately I think mortgage rates next year could come down to 2.5%. So, but they'll be coming down because there's no demand. I mean, people think housing is driven by mortgage rates. It is while the economy is okay. But when mortgage rates go down in a recession, it doesn't stimulate demand because, banks are tight. They're being very careful who they lend to. People are saying, "I'm not in a mood to buy because I don't know where my job security is." So next year when rates are low, it'll be a good time to refinance for those that can. But it doesn't mean housing is going to all of a sudden take off again.
Wow. Okay. Well, let's break this down further. So now the bust occurs sometime at the end of this year, early next year. There are many catalysts. We already discussed the fragility in the system, lots of inequalities between the haves and have-nots, and now we may even see some of the haves having issues as well. The Fed will respond accordingly, and they will be cutting. So what next? We're going to have low interest rates. However, you can't avoid what's coming. Is that correct? The recession will be here. It's going to lead to a depression, maybe stagflation. Would you say that as well?
No, I am definitely not in the stagflation camp, because stagflation means stagnant economy, high inflation. I think I lived through stagflation became a term that was invented during the early 80s when I was a money manager. And I know it remember it very vividly. That was when we had a double dip in recession in 1980 and 82. We had inflation in the high double digits. So you were in recession and inflation was high. And in between the two, the double dip recession, you had a couple quarters of recovery. That was all stagflation. What we're going to be facing is deflation, and not stagnant economy, a big falling economy, a sharply falling economy. That's the exact opposite of stagflation. It's a deflationary bust. So, I mean, those are contradictory terms. And before we get to the bust, yes, you'll have a recession, which is not stagnant, that's down, and you'll have inflation trending towards the Fed's target of 2 and maybe below. I mean, true inflation already has it at 1.3. So, those that think inflation, and this, the street is talking about inflation ratcheting up still. They're still, the
Yes.
Fed, not just the Fed, but Wall Street is still talking about tariffs causing higher inflation. And I believe, I may be wrong, but I believe inflation's already very close to the Fed's target. If you were honest about the sky and et cetera, it was capturing real estate. Honestly, the housing component of inflation is overstated right now. So if that were captured honestly, you'd be more closer to the Fed's target, if not below it. So inflation's already down near where it should be, where the Fed wants it, and by true-flation's number below it, and I think is trending towards even lower than that. So that's not inflation concern, and you have an economy that's trending down, not up. That's not stagnant. That's maybe looking like it's stagnant now, but it's soon going to look like it's worse than stagnant. So yeah, not stagflation. But in the bust, you'll have inflation, I think, negative. So you could have negative 2, 3, 4, 5% inflation or deflation. You'll have an economy that will be down more on the order of what we saw in 2008-9. Don't know if we'll get to double-digit negative GDP, but we'll certainly be above negative 5%. And you'll have an awful other industries in rough shape. And I should explain, because this is, again, one of the things that's hard for people to understand is if the Fed's cutting rates, why are you talking about the economy going from recession to a bust, right? If they start cutting, you should begin to see that cut have an impact, should stabilize the economy at some point, right? The problem is interest rates are one component, money is another component, and right sizing is really the story. If they start printing money, let's say they recognize by sometime later this summer, and I'd say probably not before August, but let's say they recognize by August, we need to start, things are starting to really deteriorate. We need to start printing money. In their mindset, they're not going back to printing 3, 4, 5 trillion dollars. They're going to be reluctant to print, but so they'll start slow and they'll print. Let's say they even see things are really starting to deteriorate. We're going to print, $1 trillion. I don't know if they'll go that fast, but that's still not nearly enough if things are deteriorating fast. It will take them many months to get to the point where the amount of money put into the system will begin to stabilize things. Not even talking about leads and lags, it's about right sizing. So the point at which they get to a right size policy that offsets the deterioration and starts to stabilize and then lift the thing, you're many, many months into a bust. That's why, even if they recognize the need to ease, their mindset is not going to move anywhere near fast enough to get to an easing that's right sized enough to make a difference. So that's a key point that I think most of Wall Street's economists miss, is that it's not just, is the Fed easing or not easing? Is the Fed cutting or not cutting? Is the Fed expanding the balance sheet or not expanding? It's how much, what degree will it take to offset the damage that's being done? And it's going to take a lot, I think, because of that leverage that's taking things down fast, because of that fragility that's making things worse. All of that, I think, means that you combine a mindset that's really, again, I understand they don't want to repeat the mistakes of the past. So as a result, they overcompensate in the other direction, and when they really need to be printing, they're reluctant because of the mistakes of the past. So it's really the 2008 and the 2020 situations that are going to cause them to be late, even later than normal. The Fed's always late. This time they'll be even later than normal. Not later in terms of maybe beginning the cuts. They've already begun. Not later, maybe even in terms of beginning to move to a little bit of expanding the balance sheet, but later in degree. They're not going to be anywhere near close to where they need to be for many months into the decline.
Yep. The Fed always seems to be late. Okay. Thank you for breaking that down for us. So deflation, severe deflation, depression, and then the Fed is going to do what it can. It will ease, it will lower rates, but it'll be ineffective. And then how long do you foresee, just a ballpark, of that time period before we see some type of recovery so that we stabilize a bit? You think it's going to be dire for like a year, 18 months, something like that?
Well, separating out the market from the economy. The
Yes.
economy, I would say, from the start of the recession to the end of the bust, because it's all one thing. The recession morphs into a bust. It's just a
Yes.
more severe downturn. From the start of the recession to the end of it, end of the bust, probably 12 to 18 months. It might be 15 months, it might be 12, it might be
Okay.
18, but so let's say the recession, we're just starting it now, or June 1st we started. So that would mean probably you're in the bust until at least middle of next year, and probably more likely through next year. Um, and then and the bust part of it may not kick in until, like you said before, late this year or early next.
Mm.
But we could be 12 to 18 months for the recession slash bust. The stock market will lead us out. So let's say the stock market peaks sometime between August and November. I'd say probably it could be Labor Day, it could be Columbus Day, whatever. But let's say it peaks in that period. It will probably be in a bear market for 8 to 10 months.
Mm.
So that means you could very well be beginning a new bull market, cyclical bull market, by next
Cyclical.
summer.
Mhm.
So it doesn't, people hear bust and hear all this stuff, and they think it's going to be 3, 4, 5 years. Stock market, I think the damage, if we have an 80% decline, most of that damage will happen in 8 to 10 months, is my guess. Now, it could stretch out, it could be a year. A lot depends on, it won't happen in one straight line. You're not going to go top to bottom in 3 months. You're not going to go top to bottom without having rallies in between. So you could have the first step down might be 40 or 50%, might be 30%. But let's say it's 40% down. You could have a 50% retracement of that and be up, halfway up that decline before you go down another leg. And it might be two, and probably could be 3 legs down. So, you could have a month or two of rally in between each sell-off, which stretches it out. So, but I'd say 8 to 10 months is probably a pretty good guess.
Very nice. Okay, well, now there's another exciting discussion here, investing opportunities. And everyone, is conditioned from 2008, 2000, 2020, the most recent, you buy the fear. Everyone talks about when you see a drop. I know everyone's going to be scared when they see 80% drop in equities and be too afraid to buy anything. But is this going to be a buyable bust, this drop? It seems that if there's a cyclical bull, maybe next summer, there's some amazing opportunities that could come available in the stock market.
Yeah, keep in mind, if we have an 80% drop, and I'll use the numbers just to make it simple again. If we go from 8,000 to 1,600 on the S&P,
Oh,
and the S&P goes from 1,600 to let's say 4,800, that's a triple, right? That's a tripling out, and it could easily go from 1,600 to 6,000. Or even a little higher than that. So triple or quadruple out of the bottom. That's just the index, right? There's going to be other stocks that could do even more than that. So there will be opportunities. I don't want people to think this, market top, 43-year secular bull market top means the end of investing. There's going to be great opportunities on the other side of this. what is not going to work very well is buy and hold. And buy and hold, as you
Mm-hmm.
well know, became kind of the mantra from probably the mid 80s on. And I've described before, that was about the time when people woke up in the industry, in the financial industry, to the reality that that rat going through the snake, the baby boom crowd, that was the reason why we had big housing boom in the 70s and 80s, into the 90s. They were also reaching that age now. They had bought their homes, they had accumulated their material goods for their homes, and now they were beginning to think about retirement. Even they were in their 40s and beginning to accumulate assets, earning enough money to have savings and stuff. And they said, we got to, and so the financial industry said, we're going to have this big growth area in terms of 401ks, in terms of retirement plans, in terms of people saving money. We need to figure out how do we attract that money. So they really became in the mid 80s. They started pushing the idea. It's not timing the market, it's time in the market.
Mm-hmm.
It's about accumulating,
Yes.
putting money in and just letting it compound. And so index investing became big. Vanguard took off. You still had the Fidelities were growing fast with their actively managed funds, et cetera. But Vanguard became the big new story, saying, you don't have to pay big fees. You just put it in an index with hardly any fees, very low fees, and you just let it ride. And so if people listened to that, and a lot of people did, they made a whole lot of money from when the S&P and the Dow and the Nasdaq were down on the floor in the early and mid 80s to where they are now. Many of those indexes went up, 15, 20 fold. So that was easy money. They didn't have to understand a lot about investing. They just kept, and of course the 401ks were set up. A lot of the companies selling 401ks gave you a list of indexes you could invest in. If you want a small cap, you do this. If you want a large cap, you do this. If you want the S&P, you do this. If you want more tech, you do QQQs, whatever. They offered them options, and they could diversify their portfolio into several different things, different indexes. That all worked great from then until now. The problem is, on the other side of this bust and on the other side of this bear market, it's it's going to be a lot harder on indexes, because not initially, because you kind of have that big jump in the first couple of years out of the bottom where the indexes will do pretty well. After that, what happens in an index after a big bear market is their leadership changes cycle to cycle. So I can remember I made my performance. I was top 1 percentile performer in the early 80s, 1982 to 19, to basically the entire decade of the 80s, because I recognized that oil was a story of the 70s, and that as oil peaked and rolled over, and as disinflation kicked in, that the stocks that would perform would be steady growth stocks as inflation came down. So I bought consumer growth stocks, the drug companies, the food companies, the steady growers out there, and this was before tech, and they far outperformed while people were still saddled with, because they still had the portfolios that were, they didn't recognize the change, and they still had oil and stuff. They were saddled with stocks that were constantly being sold off. As they lifted their heads, another crowd would come and say, I got to get out of this loser. I got to get it. So they hit distribution all the way up, and it held those stocks back, and it held the indexes back. You got the same thing here, where the tech stocks, which were the big winners of the last 20 years, will be under distribution because they got hit so hard and things are changing. You're no longer going to be in a low interest rate environment. You're going to be in a rapidly rising interest rate environment. It will switch from a leadership of tech and growth to a leadership of industrials and commodities. Those groups that can will have pricing power to outstrip the inflationary environment that they're facing. So most things are not going to be able to keep up with inflation, including the indexes. So that means that the index, like the S&P index, will be under constant underperformance pressure while you if you're smart enough to switch to a policy, to a strategy of more commodity focus, you're going to benefit from, gold's going to go from, I have a target of 4,000 pre-bust, so it's currently 31, 3,200. I think go to 4,000 this year before the bust, but then get hit in the bust along with everything else, and coming out of the bust go from maybe 2,000 or 2,500 to 20,000 by early next decade. So that can go up, tenfold.
20,000. Wow.
Yeah, while the indexes won't be able to get back to their highs of this year. So it'll make a big difference what your allocation is on the other side. A key point to understand is that leadership changes cycle to cycle. The leaders of one cycle tend to be the laggards of the next cycle. If you remember, after the dot-com bubble, the tech stocks underperformed into 2008-9 because they had been, they had so much ownership going into the bubble, and they were just constantly hit every time they lifted their head for the next 7 or 8 years. And then they started to wake up again on the, coming out of the 2009 bear market. Same thing here. Tech's going to be under pressure because they're so overowned, and the factors that drove them this time won't be so positive for them in the next cycle. As I said, the big one will be inflation and interest rates. Tech is growth. Growth does not do well when you have interest rates go from 0 to 15, or when you have inflation go from negative to 25. So it'll be the things that benefit from inflation that you'll want to own. That includes energy. Energy will be one of the big winners in the next cycle. By the way, I didn't talk about energy pre-bust. I don't expect energy to be a good performer in this final stage of the bull market. It's 60 now, and it's probably going to trade between 50 and 65 for the next, and then ultimately go to 30 in the bust. So, but in the post bust period, energy could go from 30 in where it gets to in the bust. Oil could go from 30 to 500. And so if you're, whereas energy has not been a good investment for many months here or for several years, energy will be a very big winner in the post bust cycle. So there are going to be some great opportunities post bust, but you just can't buy and hold. Those that followed the good advice of buy and hold, time in the market from 1985 to 2025, they deserve big applause, and they have every right to be happy about what they did. But that is not the story of the next cycle. The next cycle, it will be important, first of all, to probably not buy and hold through the bust, because if the market goes down 80%, your portfolio is going down 80% or pretty close. So you're better off preserving your capital. It's exactly opposite of what you're going to hear from most of the consultants out there, or most of the financial advisors out there. But if we see what I think we're going to see here in the next 3 to 6 months of a run to 8,000 on the S&P and maybe higher, you would be wise to say, I don't want to get greedy. Maybe it's time to preserve my capital, go into bonds, or and if you're going into bonds, go into treasuries, because you want that government guarantee. In the bust, the corporate bond market is going to get hit hard. So in the bust, you want the highest security that can be FDIC insured savings, that can be, to a degree, money market, because I think, even though we don't know this, in 2008-9, they protected the buck. Don't break a buck was the saying. So basically, they backstop the money market funds. That is not the case today, but I would guess if we get into dire straits, that will be one of the government's moves. Will be to say we're going to protect the money market. So money market probably, and as long as you're not in high risk money market, you're probably okay there. But if you really want to be safe, FDIC insured savings, um, Treasury, the Treasury market from T bills all the way out to the long bond should do well as rates come down. It's government guaranteed, so you have that security. The problem with corporate bonds is that in a bad economy, they may not be able to service their debt. The stronger ones will, but we don't know how bad this bust is going to be, so we don't know how strong you have to be to survive that. And a lot of companies have a lot of debt on their balance sheets, so um, you can't just say, "Oh, everything will be fine." I get questioned about municipal bonds. It's a harder call. I would just say stick to AAA if you're there. Don't assume a lower quality municipal bond could get through the bust because it may run into trouble.
That's why we're so grateful for you, David. Wise words there. Now the buy and hold is gone, and it actually coincides with your definition of this secular bull market. The 80s until today. And now we're going to have a structural change. Like you said, the end of this 43-year, now it's going to be bull market that we've had. So buy and hold is gone. That whole mantra about time in the market. We certainly need to time the market. I like the point that you made about what to own and what to look for. In an environment of higher inflation and higher rates, the growth, like the tech, we have changing leadership. That's not going to be the theme. It's going to be the real assets. Now, before we get into more of these different sectors and investment opportunities, I want to ask you about the economy. When will we see that change occur from the Fed cutting rates, rates coming down, deflation in this bust, moving to this higher inflation that you speak about and these higher rates?
My guess would be that basically 27 and beyond will be the recovery period. It could start, like I said before, it could start in the second half of 26. Depends on how fast the bust occurs, depends on how fast the central banks, and it's not just the Fed, it's all central banks, respond. But just looking at the mindset, and Lagarde has it, Powell has it, the FOMC, all the members are pretty much there. They're just not in a mindset like they were in 2008-9 because they lived through that period and got criticized for it. So they do not want to, it's not in their right now in their mindset to want to ease to print money. So they're going to be slow to do that. If that happens faster, we could come out of this thing faster. And again, it's how fast, but also how much they do fast. But my guess right now, looking at their mindset, I would guess we're probably in this through 26, the downside. Like I said, the stock market could start looking over the trough second half of next year. So you have to separate the stock market from the economy, but the economy probably doesn't turn around until the beginning of 27 or very close to that period. And then it might start slow, for normally coming out of recession, you can technically be out of a recession and still feel pretty awful. The first 6 months out of recession doesn't feel like, hey, things are great. If you remember 2010,
yes,
or even 2009, we were already beginning to recover. You wouldn't have known it from, what it looked like out there. So technically, we probably start recovering, by beginning of 2027, but that doesn't mean you're going to feel it. And, I think consumers are going to get hit hard in the bust. I think you could have a 30 to 40% hit across, basically on average in housing. So housing is that really only brings them back to pre-pandemic, maybe, if that. But that's a big hit, particularly for those that bought in the last 3, 4, 5 years. So housing is going to be, home equity is going to be down a lot. Stock, if stocks go down 80%, stock market's wealth is going to be down a lot. You're going to have, I don't know if you're going to see double digit unemployment. You could. So there's going to be a lot of people out of work. And so you take all that together, and the consumer is going to be digging out from a pretty big hole when we do recover. That means their early years of recovery, normally, consumer leads us out. I think this time around, because of what Trump's doing, among other things, all that reshoring, all that business coming in from overseas is geared towards industrial. Now, certainly the people that work in those industries are going to have jobs and doing okay. But I think you're going to see an industrial, that's part of the reason you're going to see an industrial led recovery. It's not going to be what we've had the last 40 years, a consumer led recovery. Shop till you drop. The consumer was always there. And that's the mindset going forward in the next recovery is going to be more driven by industrial and commodity. And the consumer, there'll be consumer. I mean, there'll be people who will spend the money they're earning and things, and successful people who have the money to spend. But by and large, it's going to be a consumer that doesn't have the same shop till you drop mentality. So, again, it's another reason why leadership will be different.
I see. Well, it seems that the services economy is switching more to a goods economy with the reshoring of manufacturing. That will take time to build up. So, okay. So what levels do you see during this period for oil, commodities, gold? You touched upon 20,000. How about silver? Tell us about anything else that you're thinking of how high to go.
Yeah, I think silver can get to 500 in that time. And again, my pre-bust target for silver is 75. So I don't want to skirt over the fact that we're in the 32 or 3 area for silver right now, and I think we can get to 75 this year. So there's still a big opportunity in silver before we get to the bust, and the miners will benefit from that move. As I said, gold will go to 4,000 I think can get to 4,000 before the bust. Post bust, yeah, silver 500, gold 20,000, oil 500. Natural gas, I have not forecasted this cycle because it wasn't really easy to forecast. I mean, it was driven more by weather and things, and it had a glut of supply, so it didn't really make sense to try to guess. It's down in $3-4 range. Natural gas by the early 30s could be $50. So from $3 or $4 to $50 is a pretty big run. These things that look like they have massive supply, we're going to be in short supply of a lot of commodities. That's why prices are going to go through the roof. When you've spent decades sizing down the commodity areas, the capacity for copper, the capacity, I just heard today, it's in the U.S. to build a new greenfield copper mine, to start a new greenfield, meaning a new mine, and get all the approvals. It's 29 years from the beginning of development to the end, because of all the regulations and stuff. We're not going to be able to build capacity to satisfy. This is a demand period that's fueled by all of a sudden $20 trillion coming into the system at the same time you're trying to reshore and build new plants and stuff. Plants require commodities, steel and aluminum and all kinds of commodities to build those plants, right? Alloys and minerals, etc. You can't develop new plants to produce the commodities. You can't develop mines to mine the commodities that you need in anywhere near the time frame that this demand gets ramped up. The demand gets ramped up over 5, 6, 7 years. To meet that demand will take 20, 30 years. So what gives is you have massive demand, is classic economics, massive demand, limited supply, and price goes through the roof.
Yes.
So that's why you're going to have this inflation bubble. inflation going to 25%. That's why you can have oil go from 30 to 500. We've spent, more than a decade tamping down our supply of oil, or tamping down our, we said fossil fuels are bad. We don't want that. Well, all of a sudden there's going to be, that's not going away. The demand is going to be ramped up because of the need for energy in the next cycle to meet the factories, to meet the production, the onshoring, new capacity, et cetera. You're not going to be able to ramp up capacity of supply of oil fast enough to meet that demand, and the prices go through the roof. So in the end, it'll provide an umbrella under which all the alternative energies will move up too. It's not that solar or wind or
Nuclear.
nuclear. All of those are going to have to be in play. They're all going to probably benefit, but the big beneficiary is going to be fossil fuels, because they're the ones you can at least ramp up demand or ramp up supply faster.
Yeah.
My big criticism of the whole climate change thing was, we let the government determine what we had to do rather than let the market determine. If you would let the market determine, it would have happened. You would have seen alternatives ramp up at some point, just not when they did. And as a result, you had all this misallocation of capital.
Absolutely. It set us back, certainly. Fossil fuels are the most efficient, and when we need energy, that's where we turn to. So we have the buyable bust or whatever in the market, we have an 80% drop, we have looking for commodities, looking for real assets, because the next period is going to have new leadership. So this may be next summer sometime, maybe later next year. Then it's not a buy and hold time. So we buy these commodities, we see, let's say we buy gold miners and we see gold shoot up to 20,000 as you forecast. Do we sell at that point? Will gold not remain at that level? Will it come back down in the 2030s? What do you see at that point?
Yeah, I don't want to confuse people. The buy and hold, the whole talk about buy and hold is really for this cycle coming to an end. I don't want people to think they should be traders in the next cycle. An investment that you buy in 2026 or 7 that you sell in 2032 is a buy and hold.
Okay. Yeah.
So the buy and hold is just really talking about the strategy of buying the indexes and sticking with them cycle to cycle to cycle. But you will want to invest, not trade, in the commodities in the next cycle, commodities and commodity producers. But there's going to come a time. I just think you don't want to get ahead of it. There's going to come a time in the 2030s when you're going to say, all assets are in trouble because we're collapsing. But there's a period of time from 27 to probably 2032, I'm guessing, but where you can just buy them and hold them and stick with them and not try to capture, gold will go up from, let's say 2,000 to 5,000 and then correct for 4 or 5 or 6 months. And traders can try to play that. For most people, it will be a buy and hold where if you get in the beginnings of the new recovery cycle and just stick with them for 5 years, you'll probably make a lot more money than most guys jackrabbiting around. It's the old Bugs Bunny or the old tortoise and hare story. Those that are jumping around and in and out and all around, they may feel like they're winning at times. But when you get from the beginning to the end, it was the tortoise that won the race. And so I don't want to get away from, I don't want to confuse people and tell them not to be buying holders for periods. But it's just that thing where you could hold the indexes for many cycles. That's what's coming to an end.
Thank you for that clarity. That makes a lot of sense. You go into this drop that we have, look for those real assets, prepare accordingly, and you can hold on to that until, 5 years or so, that time period in the early 2030s. And I know last time we met, we talked briefly about the 2030s, just to give people an idea of what could potentially come. I would like you to embellish a little bit about I remember you said these words, the printer is no longer operable. You're like, it's not something that the Fed can come and rescue anymore. Please shed some light on that.
Sure. One last thing on the last subject, and that is that
Yes.
it will not just be the hard assets, the commodities themselves. You can own gold or silver in that period, but you're going to be able to own miners. You're going to be able to own copper producers. You're going to be able to own oil companies. So you can still buy stocks, just buy the stocks in the commodity areas. So it's hard assets, sure, but also stocks in those areas. So in terms of the 2030s, as I say, this thing probably, if we're starting out the new cycle in 27, it's not going to end in 2030. I can promise you that. So don't, when you hear 2030s, don't hear 2030. This thing is not going to hit the next decade and stop on a dime. There's probably 2 or 3 years into the 2030s that will still be in this bull market, in this cyclical bull market, or in this period of recovery. But later in the 2030s, and I don't know whether that's 2034 or 2035 or 6, or if it happens faster, 2033, but I use kind of mid 2030s as just a general time frame, because a commodity cycle tends to be shorter. You're going to, with all that money printing, you can get into higher inflation pretty fast and overheating pretty fast. So a commodity-driven, inflation-driven cycle tends to be much shorter than a disinflationary cycle. So we had the recovery from 2009 or 10 to 2022. It was basically one cycle, right? You had the cycle of the 90s, which really barely had a recession in the early 90s. So you had a long cycle there. Those were disinflation-driven cycles. The commodity cycle is going to be much shorter. So yeah, I think it might be 5, 6, 7 years. So that gets you out into the through the first part of the 2030s. By the mid 2030s, we're looking at inflation at 25%. I think we're looking at interest rates at somewhere close to or north of 20%. Short rates probably above 20, and long rates approaching 20%. Those are numbers that are hard to fathom, because we're also going to be looking at government debt and deficits that are through the roof. If you have to not only print a lot of money but produce a lot of fiscal stimulus in response to the bust, you're going to be dealing with debt and deficits far bigger than we already have now, and the ones we have now are unsustainable. And basically you look and say, how can you solve that equation? If they're even larger than that, and then you put into that the cost of servicing that being the interest rate being high teens or 20s, it becomes an unsolvable equation, right? I mean, there's no equation I can come up with, short of some miraculous thing where we figure out that we can pay off that debt with all the minerals and the gold in our vaults and everything. I don't know how you solve a debt deficit problem when you have rates that high. So there's maybe a small possibility that there is some solution out there that I'm not seeing, or that I'm not thinking is probable. But let's assume that we have high interest rates and high debt. Basically, you reach a point, because with high inflation, the printing press does become inoperable. And I don't know at what point that is. It's double digits. When they'll try to, early on, they'll try, as interest rates move up from 7, 2, 3, 4, 5 to 6, 7, 8, 9. They'll try to print their way out of that. They'll say, we need to, the Fed needs to buy some of that debt. We need to put more money in the system to allow the government to have enough money to pay to service its debt. What happens is that money going into the system accelerates the inflation even more. So it becomes a losing proposition where you can't keep up with the inflation. At some point cross over an inflection point where inflation runs faster than your ability to keep up with it and your ability to print. So you become, it's what happened in the Weimar Republic. They kept printing money, and it became a point where, all the cartoons where you're running down the street with a wheelbarrow full of money, full of cash, and you go to the store and you can buy a loaf of bread. So it won't get that bad, but that's the imagery. That's the concept, is that at some point, probably as we cross over into double digits, it will become very hard for the Fed to print money. And that's why, by the way, this, I forget what they call it now. I haven't used the term in a little while, but the Democrats particularly were pushing the idea that because we were in a low inflation ZERP period, it looked like you could print money into infinity and have your cake and eat it too. You could always expand your debt because you could always print more money to pay that. That works for a short period of time when you're in that little sweet spot where rates are low and inflation's low. As the money starts pushing inflation up, it pushes rates up, and you lose that ability. So, it was MMT, modern monetary theory. That was that.
Okay.
So that's why that's a joke. I mean, it's not a real theory. It's a failed understanding of what money does. Milton Friedman told us over and over and over again, inflation is a monetary thing. There's the money that causes inflation. So as you go into a period where your inflation is moving up, at some point we'll tie the Fed's hands and we'll shut down the money machine, the money printing machine. And from that point forward, you have to live within your means, because the only reason we have survived the last 30 or 40 years, and certainly the last 20, is that printing press. If we did not have a printing press, we would not have the standard of living we have today. We expanded government and through the money machine expanded the debt to allow us to live in this false image that our standard of living was not dropping. We have a much bigger government, lots of people working in the government that aren't producing anything. The only reason that was all possible is because of the money printing. Once you shut down the money printing, you have to live within your means. That's when that equation becomes important, and there's no way to solve that equation. You could solve it when you had that outside input of new money. But once you shut off the money, now you have to live within that closed equation, and there's no way you can solve that equation. So that's when you begin to run into the problem of, we don't have enough, we can't raise enough money, we don't have enough means to keep this thing moving in the direction we've been moving. We can no longer grow the economy, we can no longer fund our debt. And if you don't have the printing press, you also don't have, because it quickly becomes a reality to all outside investors that the government can't fund its debt. It can't service its debt. And they say, okay, no more, you can't sell any more debt because I'm not going to buy it. Whether it be overseas investors or domestic investors, are all going to realize the U.S. government debt, which has always been 100% safe, is no longer, you can't count on it. You can't buy even a 5-year piece of paper and count on it being repaid to you, because you look at the finances and you say, I don't know if the government's going to be able to do that. So people stop buying the debt. The government loses access to capital markets. So it's even more, you have to live within your means. What are your means at that point? Your means are taxes, taxes, and how far can you raise taxes? So it all becomes a very negative feedback loop, where you're trying, everything's going in a negative direction very fast. And so I would guess by the mid 2030s, and I'm describing the US, but this is really almost every other economy is going to be in the same boat. You're talking about a collapse. we're in the end years of a super cycle. I define a super cycle as that period between the one depression and the next depression. So the Great Depression was the 1930s. The next depression is that mid 2030s, I think. So it's 100 years basically between them. And yes, we have a bust before the final depression. This is not a depression. If it lasts a year or 18 months, it's not a depression. It's going to feel like one, but it's not a depression. But that period between the 1930s and the 2030s is a super cycle. We're in the last decade of that, maybe less. And that's why everything's starting to come to a head, why everything's going to get to such extremes.
Yeah, it seems like it's the end of a great Ponzi scheme that at some point, right, you can't service it anymore and it's just unsustainable and it unravels pretty quickly. Our system is based on debt and IOU money, the fractional reserve banking, and the idea that we can always print our way out of debt is what has led to these problems. I have to ask you about crypto and Bitcoin. Trump and his team have recently said that he was going to try to use crypto and Bitcoin to help solve this debt crisis that we're having and this massive debt. Do you think that that could possibly be a solution? Is it something you've thought about? Or AI or one of these disruptive technologies? Do you think any of this could help?
Yeah, my view on crypto first is that it's at this point anyway. It seems like it could benefit those involved in it. I don't see it as a solution for our debt problems. I don't see it as a solution as a replacement for the dollar. I have a hard time seeing it as a something of macro significance. It may turn out to be something that's outside the system that while the system's failing allows you to thrive for those that are there. I don't see it's I don't see where it solves the problems of the last 100 years or last 90 years. We basically have built these excesses up cycle to cycle to cycle, and then had to in each cycle had more excesses that we then responded to rein those excesses in, and it led to even bigger pumps on the other side of the excess. That's why it's like an elastic that just keeps getting more extended. I don't see where crypto solves that. I see it as it solves a problem. It solves for those that distrust the system. It gets them outside the system. It's that's the least of our problems. Maybe not the least of them, but that's not the real main problem. It's that excess that's we've gone beyond a point of a solution, in my opinion. Now, the hopeful side of me says maybe the movement back towards a capitalistic approach, and maybe we can come up with some things that can solve our deficits and become fiscally more sound before we get to that extreme. But given that we're in the last cycle, and probably the last less than 10 years of the super cycle, it's a low probability event that Trump's policies can save us fast enough to offset what I think is inevitable. In other words, the bust is coming, in my opinion, in less than a year, probably less than a year, and the response to that bust is going to be massive. I keep saying the macro trumps Trump. That if Trump had come 20 years sooner, or maybe even 15 years sooner, maybe we had a fighting chance. But what's happened in this last 10 years, particularly the last 15 years since 2008-9, and then the pandemic, it's hard to envision that we can catch up to that fast enough, or that he even has the policies that can do it. I think what he's doing is the right things, and I still have, I'm always optimistic that I'm missing something or I'm wrong. But to be honest, I just think the odds are slim.
Thank you so much, David. Your valuable insights are noteworthy and appreciated by all. So I appreciate your contrarian view and your vast experiences. Thank you so much. Please tell our audience how they can follow and learn more about you. I see you on Twitter all the time, but I think I hear some people say that they don't think you're on there all the time. Tell us.
Yeah, I'm on there every day. I was away for 10 days, so I was, not there for most of that period, but I'm back and I'm on there every day. When people come on and say, I haven't seen you in a long while, you've been hiding, or where have you been? And I go, I've probably in the last week, and this was before I left, but probably during that period of April, I was probably responding to replies 100 times a day. So for people not to see that, it means their settings are wrong. And I'm not a Twitter expert or an expert on X to tell you exactly how to set that, but just know your settings are not set to notify you of all my replies. Most of my communications are not original tweets. They are replies to other people. So you have to have your settings set up so that you see those replies or you're missing most of the communication. Now, my interviews like this are on YouTube, and I do put out an original tweet with the link to the interview. So that's on there every time. And occasionally I do put out an original post, but most of mine are replies, and I use the replies as not only to reply to that person, but to basically use it as an education tool to everybody. So somebody asks me a question and I reply to it. It's to provide some a response that's not just to that individual. So that's why I find that the easiest and best way to. I'm on Twitter, hopefully to help educate the masses, help them at least have an alternative voice out there to what is, the common, what I call noise. There's an awful lot of people that agree out there and CNBC type views that everybody thinks is right. And I'm just there to say that, there's another way to look at the market. And basically, I've been a contrarian through my whole career and trying to help people see that, psychology plays a big role. If you can kind of counter that, you're going to be better off. So yeah, I'm on X every day. And I also put out a quarterly letter that is by subscription, which means there is a price to it. I have lots of people that like it, but it's not for everybody. It was an institutional letter originally. I've been writing it since 2000 when I was on the street. But in the last 4 or 5 years, I've produced the letter for both institutional and retail. Most of the people that subscribe to it tell me that it's very readable and understandable. It's easier for them to know than me because you get caught up in Wall Street speak and you think everybody understands what you're saying. But I tend to be pretty plain spoken in the letters as well as here. So if anybody has an interest in that, all they have to do is direct message me on Twitter or on X, and I'll provide details in terms of the cost and how to pay for it, et cetera.
Great. Well, I'll link all of that. And we appreciate you so much, David. Thank you so much for your time.
Oh, great to see you, Rosanna. Thank you.